The Federal Reserve's much anticipated September meeting has wrapped, and investors everywhere are watching closely for what comes next. Today, we'll break down the Fed's decision, its impact on the markets and the economy, and explore the forces driving the equity rally. All that and more right now on UBS Trending. Hi, everyone, and thank you so much for joining me. I'm Anthony Pastore, and this is UBS Trending. Joining me once again for this conversation is Eddie Gabor, co-founder and CEO of Key Advisors Wealth Management. Eddie, always good to have you on the show. Welcome back.
Thank you. It's always a pleasure to be here with you.
Yeah, good to see you, Eddie. So let's start right away with the big headline, which, of course, is that the Federal Reserve, as was well anticipated, decided to cut rates by 25 basis points. Just would love to kind of get started on what your thoughts are on that, and how did you interpret the market's reaction and all the aftermath since they made the cut?
Well, they really set the table in Jackson Hole on Powell's speech in August, and that's when the market really started to catch fire again after a little bit of a pullback. And so the reaction post the cut is what investors should expect. You know, the interesting thing here is we have a Fed now that is turning dovish, it's cutting interest rates in a non-recessionary environment. That's about as good as it gets for risk assets and people with the right risk tolerance. And so we think that this market is far from done in regards to the upside. And it's really a function of the timing as to when they start cutting rates, which is they're cutting rates when the market's at an all-time high in a non-recessionary environment. And so we think that this thing is going to get much, much more frothy than where we currently are.
Yeah, I want to dig in a little bit more because, as you said, I mean, a lot of what the Fed did was highly anticipated, and the markets had already priced a lot of that in before the day of the decision. But when you think forward thinking about, you know, we're expecting, by the way, here at the Chief Investment Office, 75 more cuts in total between now and sometime in Q1 of 2026. So knowing that, how do you see the markets, particularly the fixed income markets and even sort of broader economy, moving in the weeks ahead as we kind of march towards the end of the year and into January?
If we get 75 basis points more of cuts between now and the first quarter, I think what you're going to see, which we anticipate an economy that's going to reaccelerate. You know, we've seen some cracks in labor market and some slowdown economically, nothing remotely close to a recession. But our base case was a reacceleration of growth in the fourth quarter, whether the Fed cut rates or not. So if we're going to get 75 basis points, this economy is going to get overheated. You will see the inflation numbers reaccelerate, but at the same time, you're going to see the market just rip, because that's a Goldilocks scenario. If you're going to increase liquidity in an economy that growth is accelerating, that's a perfect storm for a melt up.
Yeah, I have to say that makes a lot of sense, Eddie, considering what we know and what's coming. And obviously, you know, the Fed still has their mandate for employment, and obviously they want to make sure that they mitigate those risks. So we'll have to be certainly looking at a lot of the economic data as it comes out over the next couple of months, especially the jobs numbers and, of course, inflation data. Moving on, though, you know, we can't really talk about what's going on without recognizing the fact that the equity markets, particularly large caps, and even in some cases small and mid, which we'll get to in a minute, there's been a very strong rally, up almost about 13% this year so far on the S&P 500. A lot of that clearly being driven by some of these AI mega cap tech stocks that have also shown that with their earnings reports that the guidance is expected to be strong as well. What do you think overall is fueling this momentum, Eddie? And here's the big question: is this movement sustainable? Is there more room to grow here on the equity side?
I do think there's more room to grow for the things that we just talked about structurally where we are in the cycle. We are in the early innings of loosening monetary policy while the market's at a high. So the way that the market structure is right now, you look at these mega cap names that are AI driven, they're a big percentage of the S&P 500. So it's almost mathematically impossible for the S&P to keep going up without these names getting even more and more stretched. So we do think that that is going to continue. And we are seeing a broadening out as well, too, in other areas, like you just mentioned, small caps and other places. So, and the other trend is I think you're going to see money flowing out of fixed income as well. because what's interesting is even though the Fed cut rates, the 10-year bond actually went up, which is not good for bonds. So this is why you're seeing rotation into gold, which we own a good chunk of gold for clients and have since the end of last year. And you're going to see cash flows. If you're going to pick between fixed income and equities in this type of cycle, I think you're going to see more money flows over the next few months as people try to play catch up, go into the equity space. And I'll kind of end with this as well, too. The other reason why we think we're going to see these flows, as much as this market has gone up, the amount of pessimism that I continue to see on social media and firms calling for tops and the amount of short interest in small caps in the S&P by some of these institutions are telling us that they are underinvested. And there's still $17 trillion of money market money in there. And that last leg of a bull market, you're going to see a lot of cash, in our opinion, rotate out of these shorts into the long, as well as some of these money markets going into the stock market as well, too. So I think this market can go a lot higher than most people anticipate.
Yeah, thanks, Eddie. We have an S&P price target right now of 6,800. So we still think there's room to grow there as well. Although I will say CIO currently has a neutral on equities overall, but we are saying to buy the dip, when you can find it, get in there and buy any dips that are happening within the space. Let me just ask you specifically about the small and mid cap markets. When you look at that, obviously, the small cap particularly is a lot more sensitive to interest rate moves and monetary policy, but it seems like when you look at the valuations, things are pretty cheap within the small and mid cap spaces. Are you seeing any pockets of opportunity there?
So for our clients, we own the ETF because some small cap names can, as you know, can be extremely speculative. And the Russell 2000 as a whole continuing to outperform the S&P as it has been since April. It's one of the few areas that hadn't gotten back to the 2021 highs. So that's been a long time of the Russell really underperforming. And now that we're going into a rate cutting cycle, we think the Russell will continue to outperform over the next 6 months. So we're going to increase our exposure there. And within there, you would expect regional banks to do well, right? Because the regional banks struggle when interest rates and monetary policy are tight because small businesses struggle in that environment. And a lot of times those regional banks do a lot of their banking and loans with small businesses. So we expect small business sentiment and investing and borrowing money to increase in this environment over the next 6 to 12 months, which should help the regional banks, which can be a big part of the small cap space.
Excellent. Eddie, thank you very much. And the Russell 2000 currently is price to book is about 2 times below its 20-year average. So yeah, agreed that there definitely seem to be some pockets in there. Eddie, thank you so much. It's always good to have you join the show. I hope we get you back soon. And again, thanks for all the insights.
Thank you for having me.
Great. Thanks, Eddie. Eddie Gabor again from Key Advisors. And for more information, please visit our website. It's our Insights website. The address there is ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn, Facebook, and Instagram. Plus, you can check out our dedicated Instagram channel for the studio at UBS Trending. Lots of great content then for you. And as always, if you have any questions about what Eddie and I spoke about today or anything going on in the markets, make sure you are reaching out to your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody.